If you believe the next great fortune will be made by predicting the next headline out of the Middle East, you are already thinking at the wrong level. The crowd always thinks wealth comes from drama. It thinks the money is in the explosion, the panic, the oil spike, the red candles, the television map. The expert with his sleeves rolled up explaining why this time is different. That is not where the great money is made. The great money is made one level beneath the panic, where capital gets repriced, where weak hands are forced out, where excellent businesses are briefly offered at prices that belong to fear instead of reality. I have spent most of my life studying this one principle. Crises do not create the great businesses. Crises reveal them. Crises do not tell you what to own. Crises tell you what can survive. And once you understand that distinction, the next decade starts to look very different. What people call an Iran shock, an oil shock, a war shock, a rate shock, or an inflation shock is usually just the market's way of forcing everyone to confront a truth they were already avoiding. The truth now is simple. The world wants more computation, more automation, more energy security, more digital infrastructure, and more decision systems, at the exact same time that politics, commodities, and capital costs are getting less stable. That is not a short-term story. That is a long wave. It does not end. Because one quarter disappoints, it does not end. Because oil jumps for a season, it does not end. Because television starts using words like crash and contagion. Most investors still behave as if all drawdowns are the same. They are not. Some drawdowns are warnings. Some are gifts. The difference is not in the price chart. The difference is in the earning power of the business that sits underneath the chart. When I was younger, I learned a lesson the expensive way. A falling stock is not automatically cheap. A rising stock is not automatically dangerous. Price tells you where the crowd is standing. It does not tell you whether the underlying business is becoming more essential or less. In a panic, the crowd sells both the weak and the strong because fear has no patience for nuance. That is where discipline gets paid. So let me give you the diagnosis as plainly as I can. If the next phase of this decade is shaped by energy stress, sticky inflation, uneven growth, political instability, and violent capital rotation, then the winners will not be the companies that merely benefit from one spike in oil or 1 year of defense spending. The winners will be the businesses that become more necessary when the system gets tighter, more complex, and more expensive to run. That is the frame, not what is exciting next month. What becomes more necessary when the world gets harder? The average investor will still get trapped by the same old reflexes. He will chase the obvious thing, oil spikes. So he buys oil after the move. Defense headlines hit, so he buys the contractor everyone else has already discovered. The market falls 20%. So he goes to cash and calls it prudence. He tells himself he is reducing risk. What he is actually doing is locking in purchasing power decay while waiting for confidence to return at much higher prices. Cash feels safe because it does not move. That is exactly why it is so dangerous in an inflationary world. A portfolio rarely dies from volatility alone. It dies from a slow surrender of purchasing power, from a decade spent hiding in apparently safe places while the real assets compound elsewhere. A bear market frightens the impatient. Inflation slowly murders the passive. If you want to build wealth through the next wave, you need a very different operating system, not a trader's operating system, not a headline addict's operating system. You need an ownership operating system. My version is simple. I keep a large core in broad America because betting against American enterprise over long stretches has been a poor hobby for a century. Around that core, I build a focused sleeve of companies that sit at unavoidable bottlenecks, not fashionable stories. Bottlenecks, places where demand is rising. Alternatives are limited, and the world cannot solve its next problem without going through them. In this cycle, I see 3 bottlenecks that matter much more than the average investor understands. The first bottleneck is reliable power. Everybody wants to talk about artificial intelligence as if it floats in the clouds. It does not float anywhere. It sits in data centers. It burns electricity. It requires cooling. It requires backup systems. It requires transformers, switchgear, on-site generation, and stable power architecture. There is nothing abstract about it. If intelligence demand keeps rising and electricity infrastructure does not keep up, the shortage does not show up first. In a philosophy seminar, it shows up in pricing, procurement, backlog, and margins. That is why I do not get excited by cyclical oil guesses dressed up as long-term investing. I am far more interested in the companies that help the world build around the constraint. I want the companies that enable electricity, cooling, continuity, and resiliency. I want the picks and shovels behind the power problem, that leads me to businesses like Vertiv, which sits inside the cooling and power infrastructure layer that AI and data center expansion cannot ignore. It leads me to Bloom Energy, which offers a way to create power closer to demand instead of praying the grid arrives on time. It leads me to companies tied to nuclear and stable baseload exposure when the market starts remembering that cheap, constant power is not a luxury, it is a precondition. The average investor often resists these businesses because they do not sound as glamorous as the chip designer or the chatbot app. That is a mistake. The glamour layer gets attention, the bottleneck layer gets paid. I have seen this movie before in other forms when everyone rushes to the frontier. The smartest money quietly buys the toll roads, the rails, the picks, the power, and the data plumbing. The crowd wants the symbol of the boom, the disciplined investor wants the infrastructure without which the boom cannot happen. The second bottleneck is memory. This is where the next great misunderstanding lies. Most people think AI is simply a race for more chips. That was yesterday's bottleneck tomorrow. Bottleneck is not only compute, it is memory bandwidth and the ability to hold and move context at scale. The more capable the models become, the more memory intensity matters. The more agents, workflows, and enterprise applications grow, the more this bottleneck starts to print its reality into order books and margins. There are entire categories where the world does not have enough capacity, and building it takes time. That time lag matters whenever demand accelerates faster than supply can be built. The companies already sitting on productive capacity become absurdly important. That is why I pay attention to Micron, not because I expect a straight line upward, I never expect that. I pay attention because it sits inside a market where the right kind of memory is becoming strategic, not optional. If the world needs more high bandwidth memory and qualified production is limited, then the gap between what the market fears in the quarter and what the business can earn over several years becomes exactly the sort of gap that creates wealth. The crowd sees a cyclical semiconductor chart and gets nervous. I see a business sitting near a strategic choke point during an infrastructure expansion wave. Those are not the same eyesight. The third bottleneck is production and decision quality. Whenever the world gets more chaotic, the premium on making better decisions faster goes up. Supply chains get tighter, security gets more important, errors get more expensive. Enterprises do not suddenly decide they need less visibility, less software, less connectivity, or less automation. They decide they need more of all four. This is why I care so much about the companies that help the system function under pressure. Some help design semiconductors, some manufacture them, some provide the connectivity layer, some sit in cybersecurity, some sit in cloud and data architecture, some help institutions convert chaos into decisions. The details differ. The logic is the same. If the system becomes harder to run, the tools that help it run become more valuable. That is where I put businesses like ASML and TSMC in one mental bucket. One sits at the machine monopoly layer, the other sits at the manufacturing choke point. I think about Cadence and ARM in another bucket because design and architecture remain essential even when the market acts bored. I think about Amphenol as part of the connectivity and plumbing layer. I think about Microsoft, Amazon, and Alphabet not just as giant popular stocks, but as systems that become embedded deeper into enterprise behavior over time. And yes, I think about Palantir as one of the purest examples of a company whose value rises when the world becomes more complex, more dangerous, and more data saturated. People often misunderstand what makes a business powerful. They think it is branding, they think it is hype, they think it is charisma, usually it is necessity. The strongest businesses are the ones that become harder to remove each year because the institution on the other side has built more and more of its decisions around them. That is why I care more about dependency than excitement. A company that your customers can postpone is one kind of investment. A company that your customers increasingly cannot function without is another. The latter is where long-term fortunes tend to hide. Now let me tell you what not to do, because avoiding a stupid mistake is often worth more than finding a smart idea. Do not build your next decade around a 3-month commodity thesis and call it a long-term plan. If oil spikes, many oil-related names may enjoy their season. Good for them, seasons end. I am not looking for a season. I am looking for a business that can still be better, richer, and more embedded 10 years from now after 5 different headlines have come and gone. Do not confuse a defensive stock with a compounding stock. A defensive business may hold up better in a panic. That does not automatically make it the best long-term home for capital stability matters. So does reinvestment runway. I want both when I can get them. Do not run to 100% cash because the map on television turns red. Cash is a tool. It is not a religion. You need dry powder. You also need exposure. The investor who moves entirely to cash in fear is often just prepaying a future regret. Do not use debt or margin to chase chaos. This is where amateurs turn opportunity into self-destruction. A drawdown is survivable when you own your assets outright and can wait. It becomes lethal when a lender controls your timeline. Time is the one weapon the patient owner has. Margin hands that weapon to somebody else. Do not buy all at once because your ego wants to catch the exact bottom. Nobody rings a bell at the bottom. The market's favorite way to humiliate people is to let them feel clever for a week and stupid for a month. I prefer a slower, more rational method. I accumulate, I scale, I keep enough cash to keep buying if the discount improves. That is not glamorous. It is effective. The investor who survives the next decade well will not be the one with the hottest opinions. It will be the one with the strongest protocol. My protocol is boring enough that people underestimate it. Broad market core. No leverage, durable watch list. Add only to businesses I can still explain in plain English after the adrenaline fades. Buy more aggressively when valuation compresses without breaking the operating thesis. Keep a list of what would make me sell before I buy. Ignore the daily theater unless it changes earning power. That last part matters more than people think. News is loud because it is monetized by attention. Earnings power is quiet because it is monetized by patience. I learned a long time ago that the long-term scorecard is not written by headlines. It is written by revenue, margins, capital allocation, and the widening or narrowing of a moat. If a business keeps expanding its revenue base, improving its margins, and strengthening its necessity to customers, the stock can be mocked, doubted, or misunderstood for a while. In the end, the economics tend to overpower the noise. That is why I always ask the same question first. Is this company becoming more essential or less? If the answer is more essential, I care very little whether the market gives me 6 months of ugliness. In fact, I welcome it. Because ugliness without business damage is just a transfer mechanism from the impatient to the patient. Let me make this concrete. Suppose the world gets a real energy shock. Oil jumps, inflation expectations rise, rate cuts get delayed, weak businesses wobble, indexes sell off. Retail investors panic because their portfolio values are suddenly telling them stories they do not want to hear. What happens next matters. The crowd will assume all technology is doomed because rates are higher and fear is everywhere. It will treat an enterprise infrastructure company, a data center power company, a memory producer, and a weak speculative software stock as if they all belong in the same bucket. They do not. One group is facing a valuation reset because the market is scared. The other is facing an existential reset because the business never deserved the valuation in the first place. Your fortune will be decided by whether you can tell the difference while other people are too emotional to care. That is why I keep a shopping list long before I need it. You cannot build judgment in the middle of an avalanche. You build it in quiet times when nothing forces you to act, when your pulse is normal, when your ego is not screaming at you to do something heroic. I decide in advance which businesses I would be proud to own more of if the market handed me a discount. Then when the discount arrives wearing a scary costume, I recognize it. The average person thinks the key to wealth is knowing what will happen next. It is not. The key is knowing what you will do if one of several painful but normal things happens next. That is a much more powerful framework. I do not need to know the exact path of oil, the exact date of a ceasefire, the exact language of the next Fed statement, or the exact quarter when memory pricing tightens. I need to know which businesses become more valuable if the world moves toward energy scarcity, digital complexity, enterprise automation, and power hunger over time. Once I know that, I need only discipline, liquidity, and patience. That is how you turn chaos into a compounding machine instead of a panic attack. There is one more identity shift I want you to make, because without it you will keep falling back into old habits. Stop thinking like a tourist in the market. Start thinking like an owner with a protocol. A tourist looks for action. An owner looks for asymmetry. A tourist asks what is hot. An owner asks what is indispensable. A tourist wants to be entertained. An owner wants to be paid. A tourist thinks in headlines. An owner thinks in decades. Once you make that shift, the entire opportunity set changes shape. You stop asking whether the next shock will hurt. Of course it will hurt. Price volatility always hurts somebody. You start asking which companies will come out of the other side with stronger relative positions because weaker competitors, tighter customers, and higher barriers just handed them more of the field. That is how empires get built in business, not in the easy years and the hard years that expose who can fund, build, scale, and endure. If I were building fresh capital through the next decade, I would do it with that principle burned into my forehead. I would keep a meaningful S&P 500 core because America still owns an extraordinary amount of the world, productive capability, innovation, and capital market depth. I would pair that with a hand-picked sleeve of necessity businesses tied to power, cooling, memory production, enterprise software, cyber defense, connectivity, and automation. I would refuse margin. I would accumulate slowly. I would save my aggression for moments when fear offers quality at irrational prices. And I would never confuse motion with progress. A lot of people will waste the next decade trying to be clever. They will jump from theme to theme, oil one month, defense the next, gold after that, some crypto idea after that. They will call it adaptive. Most of the time, it is just emotional wandering dressed up as sophistication. Real wealth usually comes from standing in the right places for a very long time, not from running in circles quickly. That is why I am less interested in the next quarter than in the next 10 years. I do not need every position to double tomorrow. I need the underlying businesses to become more embedded, more necessary, and more cash generative while the world gets louder and more dependent on what they provide. If that happens, price eventually follows. Not because the market is moral, because the market, for all its daily insanity, still has to bend to mathematics over long stretches. Revenue matters, margins matter, free cash flow matters, returns on capital matter. The rest is a costume department. There is another reason this matters so much right now. A lot of investors secretly know what quality looks like, but they still fail because they have no buying protocol when volatility arrives. They think conviction alone is enough. It is not. Conviction without structure turns into hesitation on the way down and recklessness on the first bounce. The disciplined owner decides in advance how much to add at a 15% decline, how much at 25, how much at 35, and what business deterioration would cancel the plan entirely. That is how you keep fear from editing your intelligence in real time. The household level matters too. If your bills, your time horizon, or your sleep are dependent on the market going up next month, you are not investing. You are negotiating with anxiety. A proper portfolio should be built so that temporary price weakness does not force permanent decisions. That means enough liquidity, enough diversification, enough broad market exposure, and enough humility to admit that even the right businesses can be early ugly and misunderstood for longer than your ego prefers. I have never believed that courage means buying everything at once. Courage is holding your standards when the market is trying to replace them with emotion. Courage is saying no to a bad business in a hot sector and yes to a great business in a hated tape. Courage is letting the crowd call you late on the way up and foolish on the way down, then collecting the compounding anyway because the underlying economics kept getting stronger while the noise kept getting louder. So here is the final test I want you to use, the one that separates a genuine decade-long opportunity from a temporary excitement trade. Ask yourself this: if the headlines vanished for a year, if the television went dark, if the social media profits disappeared, and if all you were allowed to study were the next 5 years of revenue, margin, demand intensity, and strategic necessity for a business, would you still want to own it through a panic? If the answer is yes, put it on the list. If the answer is no, it was never an investment. It was just a mood. That distinction will decide more fortunes over the next decade than any geopolitical map ever will. History will probably be made again. It always is. People will call it unprecedented. It never is. The costumes change, the pattern does not. Stress rises, prices break, weak hands sell, great assets get mispriced, patient owners buy. Time does the rest. I have made my peace with that cycle a long time ago. The next great wealth opportunity will not belong to the loudest people, the fastest people, or the most frightened people. It will belong to the ones who understand that a crisis is not an event to predict. It is a threshold, a mirror, a contract with your future self. When that threshold opens, the market will ask you a brutally simple question: were you building a watch list or were you building excuses? That is the whole game.